Here's one on a 30-minute chart with the Aussie dollar versus the U.S. You'll see you have a butterfly pattern forming on the 30-minute, and then you have a 3-drive pattern forming also, showing you how the patterns intersect. And you'll see that the retracement back here is exactly 61%. The reason why these things work, I'm not actually sure. I think it's related to the fact that, you know, we're all, you know, human beings. We have this electrical conduct that we use because of our bodies being so much water. There is one book I would really recommend you get. It's free. I'll have Matthew ask Shelley how to get you the link. It's by Dr. Al Larson. It's called Your Electric Life. I've known Al for 30-some years. He's an engineer. He's in the Obi-Wan Kenobi class of mental stuff, folks. Let me tell you, I've never met anybody any smarter than Al Larson. And he wrote a book about this, about how our bodies are like little batteries and what makes us move and click and all this other stuff. And believe me, he's spot on as far as I can get as a description of what we really do and why we react the way we do. The harmonics is nothing more than each of the things that you trade has a certain DNA molecule that makes the market move the way. It's like a vibration of a tuning fork. Once it starts, the market repeats and repeats with these numbers. And what you do is you go back to the principle of the Doppler effect. In other words, if you have something that's going to affect something and you're going to drop it into the water, it's going to depend upon how high you're going to be, how deep is the water, and the person that actually said it. So if Bernanke says something, that's a big thing. He's saying it in deep water, and the rock is going to be very, very heavy, and that's going to make these wide vibrations very, very wide until that thing that he said, you know, finally dissipates. I say something, it's like a feather or a gnat sitting on the water because no one knows who I am, so it doesn't mean anything. But if somebody big like him says something, this is what stimulates the market for move from one area to the next, is this vibration theory. And if you'll go back and look at the 20-minute chart, you'll see that many of these swings will be repeating to themselves over and over again. They're just one after another, and you have to learn to repeat them, but that's what the harmonics are about. They're good for telling you how much you have to risk on a trade. You shouldn't have to risk more than one harmonic, and your first profit objective would be the first harmonic. In other words, the first move that the market makes. At the very end, you should be able to pull up a chart like this, looking at all the ratios and proportions, and it would have all the patterns in it. And it would give you an idea of, you know, you see a 3-drive to about it, drive 1, drive 2, drive 3, and then you see a Gartley pattern that forms here. We have an A, B, C, D, and another big one that's here. This is the ideal situation at the very end, that after you've done this, you've been able to cover it for quite a bit of a career that's lasted 50 years. I started my first trade in 1959. This is what I do, exactly the way I did it. I've tried to do it in an hour or so to give you an idea. It's much more complex than that, but that's the basic of how I got to pattern recognition and these patterns and ratios, and they fit together, and with some of the cycle things that we look at also. These next couple of slides are from my very good friend Mark Douglas, who wrote a book called Trading in the Zone. I recommend that you buy this book and read 2 or 3 pages every day. It will do more than anything else to help you be a better trader. These are the things that you really need to know about trading. There's 5 fundamental truths. Anything can happen in the market. That's why you got to be prepared for it. And every moment in the market is unique. In other words, the bid and offer of that person to take the bonds from 129.30 to 131 takes a great deal of effort. So that is a uniqueness of the market. And people, you do not know who's out there trading against you. So you really have to have some idea of risk control and protecting yourself. Your edge is nothing more than having an indication of a higher probability event happening over another. That's what the patterns will give you. You have to remember, number 4, that there's a random distribution between wins and losses. We're always dealing in probabilities, never in certainty. And the best one is this last one, is you really don't need to know what's going to happen next to make money. That's a simple thing because you don't know what's going to happen next. So, you know, you've got to be able to get something as an edge you know, and make it that way. I had a director when I was trading for Drexel Burnham in Beverly Hills in the Milken building back in the mid-'70s, and he used to say, one of his clients came in, he said, Bob, he says, you know, he said, if I go long, I lose money, and if I go short, I lose money, and if I don't trade, I miss a hell of an opportunity. So what we want to try to do is to go long and short with a little bit better opportunity than that. The next one we have is the typical trading errors that people make is they hesitate, you know, they don't get in right when they jump the gun, they get in too soon. Number 3 is one of the most important, is they don't define their risk, and it turns into be a really bad one. And you have to define your risk in advance of putting on a trade. That's the only thing you can control in the risk-reward situation. Getting out of a winning trade too soon and leaving money on the table, you know, letting a winning trade turn into a loss, or move across. This number 7 is where most people make their mistake, is they place their stops too close. They trade it right in the flutter of the market. If they would study the harmonic numbers, they'd realize if you put your stop beyond the harmonic number, you're going to have a chance of actually being profitable in that trade. Even if you get it wrong, that could protect you enough to really do it. Remember, it's much better to be out of a market wishing you were in than in a market wishing you were out. Here's the trader's creed. Objectively identify your edges, predefine every risk on your trade, accept the responsibility, and let go of the trade. Don't watch the monitor. The monitor is not your friend. If you're long, you focus on the upticks. If you're short, you focus on the downticks. If the market's going down and you're long, you're thinking, oh my God, goodbye house, goodbye car, goodbye college education, goodbye wife. And you don't really need to watch the monitor. Just put your order in, put your stop in, and then go watch something else. If you buy silver, go look at the euro. They trade differently, and you can learn something by trading silver, or not even trading silver, but just get your mind off the euro. Continually monitor your susceptibility to market errors. Keep a small little diary and write down the 1 or 2 things that you do right or wrong every day. It'll become like an anchor, and you'll really make you a you know, something like neurolinguistic programming. It just anchors yourself, and you'll know that you're doing the right thing all the time. Golfers and sports enthusiasts do this all the time, as do doctors. They're creatures of habit, doing, you know, surgery and all their examinations the same way. And the number 7 is you're consistent because you violate all these principles, but frankly, we all violate them once in a while. The difference between the professional trader and the non-professional trader will be the one that is the one that recognizes their errors, you know, a little faster than others. I think that's about it, and I will be happy to answer any questions now if anybody has any.
Catherine's asking, what was the date that you mentioned in August? You know what
they're actually, the month of August has 5 what we call P-index days. These are known as Pesavento index days. These are the days where there are in the sky, there are so many things hitting or so little things hitting that it makes it a, this is the most accurate of all the stuff we do in astrology. We had one on August the 2nd, which was the big up day on Monday. We had one on the 4th, which was the big up day on Thursday. We have one, a large one coming in on the 11th, and then we have the granddaddy of them all coming in on the 25th and 26th of August, and that is that means there's 5 in 1 month. Ordinarily, we have somewhere between 12 and 14 P indexes in a whole year, and we have 5 of them in the month of August. That's never happened before in recorded history. So I don't know what it means, but it's going to be something big enough that it should be the event of this decade. It might be the event of the century.
Do you have any charts that you can show us of what your current projection is of the market as a whole?
Yeah, if you'll give me a second, I can pull it up. Is my screen still showing?
Your screen is still showing, yeah.
Okay, let me go into Ensign, and I'll pull up the prediction, and you can take a look at it. It should pop up without too much trouble. Let me get it here. Okay, there we go.
Now you use software to plot these points, right?
Yes, it's Ensign software. Out of it's $50 a month, basically. This is what you're looking at. The blue line is the Bradley model. And this is the steepest, steepest descent that we have here is the steepest descent that we've had since 1931 in the market. And here we are at a 61% retracement of the move from the high. This was a P-index day back on April 25th. And we've had these three big rallies. This has been the largest at the 618. And if it's correct, we should start down pretty dramatically here, and you know, it should have some fireworks in the month of August. But we'll just have to wait and see. This is just a probability-based system. It's not 100%, but it's better than 70% for sure.
So do you recommend when someone's starting out learning your these strategies that you talked about today, that they do it by hand on paper first, or that they should?
Yes, do it by hand. Let me show you how easy it is to do it by hand. I'm just going to come up here, and let's just pull up something that we haven't looked at. We'll just grab here. I'll just show you the pattern in Baidu that we're looking at. This is Baidu. This is what you live for. I don't know if this is not going to work or not, but this is an absolute beautiful pattern. You can see you have two expansions coming in at 1.27 and 1.618. The market left a big gap a few days ago, and it's got several of these patterns coming together. And this is what you wait for. You don't have to risk very much, but the probability of it working is quite good. Now, all I'm going to do now is I'm just going to pull up one chart here. We'll just grab a chart like here. We'll just use J.P. Morgan. That's a big one. I'll put J.P. Morgan in here like this, and all I'm going to do now is to draw one of the patterns that we're looking at. I'm going to take out everything in this chart, and this is all you're looking at when you're looking at J.P. Morgan. You just go back and just take a look. And if you just start with J.P. Morgan at any time, we'll just do it from here. What you want to look for is just mark highs and lows. Now there's a high here, and you take it down to your low, and then you go up, and you'll see that the ABCD leg measured exactly to right here. That's what you're looking for. And you're watching these patterns to find them, you know, when they go from here to find the lows like that. That's what you're trying to do when you're doing pattern recognition. It's nothing really more than that, is to find you want. Now, I trade Forex, I trade commodities. I don't trade stocks a lot because I get so many more patterns with the commodities and with the Forex than I do with stocks, and stocks are very slow, and the margin on the stocks is, quite high compared with what you get when you're doing the the stocks are just too low. Now here let me just show you. Here's an A, B, C, D in Baidu right here. There's an A point right here. There's A, B, C, D. There it is. There's A, B, C, D. This pattern is built right into the program, so that anytime you want to draw it, you can actually draw it and it'll do it. You can just pick up any particular low, go to a high, it'll take you up to the next high or low. And that's what we're trying to do with pattern recognition, is to do that. We're doing it in the context of the Fibonacci summation sequence, but it's still, you got to add it together. It's not just one thing. It's a combination of a whole bunch of stuff.